So let's get the show on the road. We're going to talk about automated options trading. We're going to look at spread trading and some other strategies as well. We have a proprietary solution for you that generates these trades and these trade ideas, and you can use those one-touch trade alerts to respond and then have the trade automatically populate your account. We'll look at automated risk and profit management. So you don't need to screen watch. We're going to look at some back testing. And then, of course, you have yours truly and others on board with our team as your trading coaches. We're licensed and experienced, been doing this for a long time. So remember, we're speculating, and speculators always accept risk in order to make a profit. So whenever there's profit, there is risk. Do take a moment, look at that risk disclosure. You might want to do a screenshot of that or get a picture of that. I'm not going to read every word of that. But keep in mind, you should only be using risk capital when trading, and past performance is never a guarantee of future results. A little bit about Altivest. We've been a registered introducing brokerage firm for about 27 years. We've traded millions of contracts along the way that some of our staff and colleagues on the S&P 500 trading pit. That's me, yours truly there in the middle there. We are the creator of the Dragonfly option strategy and our proprietary order execution technology and platform, as well as those trade alerts I mentioned. Of course, along the way, after decades of trading, we've really done tens and tens of millions of contracts. We're registered with the CFTC, a member of the NFA. We're located in California. And a little bit about myself. I'm a co-founder of Altivest. Since 1991, I've been licensed in the futures industry. I graduated from USC, University of Southern California, with my BS in Business Administration. I've held various securities licenses, and I currently have my Series 3 commodity futures and also a 65 that's for investment advisors. Okay, what I'm going to do here is I'm going to turn off the camera, and we're going to get into sort of the meat and potatoes here. Remember, when you're trading, there's someone taking or something taking the other side of those trades. And you might think, oh, it's somebody like this. That might be your competition, but that's not really the case. This is your competition. Algorithms and computers. 90% of US equity trading volume is systematic trading. It's according to JP Morgan. So this is your competition. You've got technology, high frequency trading algorithms, so on and so forth, machines, and they've got built-in controls, automations, mandates, you name it. So there's no emotion involved with what they're doing. So how can we use our professional options strategies to compete in that environment? The answer is yes, we can. And we can trade options like the large institutions and money managers do on Wall Street, similar to how an insurance company might trade options. And what does that mean? Well, you get paid premiums to assume risk. You're selling and managing time along the way, but you always hedge yourself. And you're consistent and you're patient in your process. And you look at math, really probabilities, favorable longer term odds and statistics. Insurers, life insurers look at actuarials, probable outcomes, that type of thing. So we're looking for the odds to be in our favor, the longer run odds. So we're going to try to collect premium when we're trading futures options here and look at some strategies where we manage risk and reward. Remember, don't get greedy. You need experienced people to help you, and you need the correct tools, of course, or else it could be overwhelming. We're going to look at lots of strategies for base hits. We're not going to look at strategies for grand slams. Those have low probability of occurring. And some of these strategies are really referred to premium collection or short strategies. where they can be non-directional, bullish, or bearish. And every one of these strategies here has a targeted outcome with a fixed maximum risk that you would know in advance. So before we jump in, we're going to learn a little bit of the Greek language here. We're going to look at the probabilities, and the first letter here we're looking at is delta. So how much does the option value change with the change in the underlying index? And also the approximate probability of an option expiring in the money. And if delta is at 0.25, remember there's a 25% chance that it would expire in the money, but conversely, the way we look at it is there's a 75% chance it would expire worthless. And of course, delta is always moving with price and time and movement of the underlying asset. It is not the probability of a winning trade. So don't want us to be confused about that. And theta is sensitivity to time. Options are a decaying or wasting asset. They have limited life. And theta is a negative number, equals 1 day of time decay. So if an option's at 10 points and theta is negative 0.05, all things remaining equal, the next day the premium drops to 9.95, and the next day 9.90, and so forth, just because of the loss of time on that option. This is what it looks like on a graph. As you approach time 0, the percent of that premium remaining drops and drops and drops, and it really starts to fall off more dramatically in the last couple of months or so of the lifespan of the option. So Wall Street pros are using multi-leg option spreads to collect premium. This woman here on CNBC, she talks about an option spread is buying and selling different contracts. It's a common way for investors to hedge risk and volatility. It's usually cheaper because you can offset your cost by the proceeds from different contracts. And she's absolutely correct. And it's also been used by Wall Street professionals for a decade. So let's try to emulate what the professionals are doing. That's the whole idea of what we're trying to accomplish. Here's one simple example. Here is a call spread on the S&P 500. You could place a trade like this if you're bearish, maybe even moderately bullish, or perhaps have no directional bias. Here's what it might look like on a graph. You sell a call at this red line here, and in this case it's a 64.10 strike. You receive 4.5 points. Put that in your pocket. But at the same time, you buy a further out of the money call, and that's a hedge or some protection or insurance, and you pay 2.25. So the net result is you collect 2.25 points, $112.50 in this example, minus commissions. And this is what it might look like here. See the underlying market kind of chops around, and ultimately this trade, for example, would probably work well. You see the expiration date here is that vertical line. So that's just selling a call spread. The opposite here would be selling a put spread. And here's what that would look like. In this example, you sell the 54.20 put, that's the red line, and you buy the 5400 put, and you pay money for that, but the net result is you collect premium on that. And you'll notice that this underlying movement here on the market, the S&P 500, on this put spread we sold, it's the same movement on this call spread we sold. So really, out of the money call spreads, put spreads, when they're done in the right time frame, and I'll show you why we don't do real short dated options, but you can have movement kind of chopping around, going up or down, and these types of strategies can still perform well over time. Then here's a condor, iron condor strategy, and it's an example of a put spread and a call spread. And it's just a combination of the two things we looked at. So you sell this out of the money call spread here, and you sell this out of the money put spread, and you do it simultaneously. And you can see the arrows representing the call you sell and the call you buy, and the put you sell and the put you buy. And you're collecting net premium on the puts you sell and on the calls you sell. And then here's what the market would have done in this historical example. And so the idea is the theta decay works and it loses time value, And remember, these are covered spreads, so these are not naked. But here's what happens after theta decay. In this example, you can see the market kind of went a little higher and then dropped. And then right here at this blue arrow, right here at this point, you can see right here on this date, 12/20, I have a blue arrow here. There's a blue square, and I'm going to explain that, but that's your exit signal. So then you buy it back for less money than what you originally received, and you're out of that trade. You can see the expiration date here. So that's a good example of an iron condor, conceptually speaking. And here's a dragonfly. It's 6 legs, and you can see the condor has 4 legs, or 4 different options, 4 different strike prices. The dragonfly has 6 legs. It's just a variation on the condor. Looks a little bit busy here on the graph, but we'll look at some live examples. You're selling 4 calls, buying 3 further out of the money, and then 1 closer to the money call. And then same with the put, same structure on the downside. The red are the ones you're selling. All right. And then after theta decay works its magic on a dragonfly, just like a condor, you hope to buy back that spread for less money than what you originally received for it. So you're in this case selling high and trying to buy low. And you can see here you get a signal where it turns blue that says take profits, and that's right here at this point. And we're going to look at some examples, especially you want to stick around for the trade alert. We're going to do a live trade alert and respond to that. Here's an example of what a trade alert might look like. So you'll want to see that in just a few minutes, where you just touch accept or reject on your device or through your browser, either way. But here's the question most people have is, with so many different possibilities when you're trading options, which markets are you trading? What strategy do you apply? And what price are you using? In other words, what's your entry timing? And how do you manage the position for risk and profit? So that's called Theta Trader. That's the solution for pre-built option spreads that we created. And our proprietary algorithms will create the theta trades, as well as these one-touch responsive trade alerts. You're going to want to see that. Strategies for any market condition. And then you'll look at the automation for something called the risk thermal indicator. And that was that little blue square I showed you on those prior 2 examples for risk and profit tracking. So we'll go ahead and we're going to jump into a demonstration here. But let me switch screens for you. Just takes a moment. Okay, I think we're in good shape here. You're looking at the dashboard for Theta Trader right here. And you'll notice there's some active trade alerts here at the top, and I'll go through that in just a moment. You see the menu up here. It looks a little different in your live account. You wouldn't have some of these features here because this is my demo account for webinars and so forth. But you'll notice Theta trades are in this section here, and I'll explain that. These are your open short positions. You can see everything on your dashboard here. And then any open long or bought positions. And then this is your account info. So everything is integrated with your AltaVest trading account. And any current quotes right here. So let's first look at Theta Trade. So these are generated every day by the algorithm, and we're trading the E-mini S&P 500. There's gold, and I'll talk a little bit about that in a few minutes, a little bit later. But for now, we're going to focus on the E-mini S&P 500, the NASDAQ 100, and the Russell 2000. Those 3 stock indexes are the primary volume and open interest that we're trading. And the good reason for that is that's where really the world is trading. So you want liquid, deep markets to trade in. And also we're looking at bearish strategies, neutral or  and bullish strategies. So you can see they're pre-populated for you here. And since we've looked at the condor and the dragon already, let's jump into that. And let's look at a condor for today. You can see there are these available February end of month expiration. The strike prices are already pre-selected, as well as the expiration and the value on the trade. We'll go ahead and drill down into this. Let me expand the screen just a little here. There we go. You can see it better now. So we're looking at a condor for the February end of month expiration. And before we dig into this table, let's look at the graph. You can see all this choppy trading. You had a rally, a pullback, a rally, really roller coaster ride there. So here's where we are now. So you're selling this call spread above the market and this put spread below the market. And you can see here it has 44 days till expiration, your expiration date, current quotes. Here's the settlement value, 2.35 points, your put risk, call risk, commissions, capital, cash required. I won't go to every detail, but I want to jump down here. You're selling this put here, the 55.10, and you could change these strikes if you wanted, but the algorithm has chosen these. And I'm going to point out the cash required on the trade is just over $900. And the maximum profit potential is about $100. So you might be thinking, why would, it doesn't make a lot of sense. I'm going to put up 1,000 to make at most 100. Well, the reason why is if you look at the probabilities according to the delta, this put that you're selling here, this put here has a delta of 9.86. So that's over a 90% probability that this put that you're selling is going to expire out of the money. And look at the call that you're selling, the delta is 6.6. So over a 93% probability that the calls you're selling would expire out of the money. So those are those higher probability outcomes, and the math is really kind of speaking to us here. And you'll notice something here, I'm going to touch on this, called the TROC, targeted return on capital, and then TAR, or targeted annualized return. And this is all explained in a tutorial as well. But you'll notice up here, you see the targeted annualized return column, and the trades with the shorter days till expiration will always have a much higher TAR, but that's really not realistic to expect to generate those types of returns per year. It's really there to compare one trade to another, just kind of pointing out that the distinction between different trades and different durations. So really to compare one trade to another. All right. Now you'll notice here it's defaulted to a sell. You can try to buy the condor, which sometimes, we can do, but in this case we're selling the condor, so you're collecting premium. And quantity is 1 by default, but if you go up, you see the cash required goes up as well, and your profit potential goes up. So maybe we'll do 6 of these. So there's our cash required and our profit potential, and we'll leave the value there, and then you press place here, and that would submit the order for you. So there, we've sold 6 of these, and it just assumes you're filled in this demo account. And let's jump back here and let's look at a dragonfly. Then I want to show you the trade simulator so we can back test, kind of a time machine for back testing some of these ideas and these strategies. Then of course we'll show you those trade alerts. I'm not sure why it's taking so long. Maybe I clicked the mouse 2 or 3 times and I shouldn't have. Give it just a second here. And if not, I'll just refresh the page and we'll look at a dragonfly for today. Let me try this here. Hopefully everyone can still hear me okay. My internet connection didn't glitch out on us. Okay, so we'll look at a dragonfly. I don't know what that delay was all about, but here's the dragonflies, and you can see here you've got multiple expirations to choose from. We'll look at this March end of month dragonfly. You'll notice the TAR here on the dragonfly. The numbers are quite a bit less, or lower, I should say, than the condor, and that's pretty typical. And the reason for that is the dragonfly is a little bit more risk averse, and I'll show you why. But let's look at the graph here on the dragonfly. So you'll see here on the dragonfly, remember that you buy an additional call here, and you buy an additional put, and that provides additional insurance or protection on the trade, but that costs you money, so it limits your profit potential compared to a condor. But over time, it might be more favorable in a sense that it can create a more robust trade when it comes under pressure. Let's take a look here. You'll see here the same metrics, settlement value, premium, put risk, call risk, commissions, available capital, cash required. So you see your profit potential, targeted return on cash, targeted annualized return. And again, we're going to look at the puts and the calls that the algorithm has chosen to sell, because that's where the risk is when you're selling options, or going short options, I should say. So the 9.87 delta on the puts leaves you with over a 90% probability that those puts would expire out of the money. And then a 6.59 delta, so you're over 93% probability that the calls you sell to someone else will expire out of the money. And if you want to do the difference of quantity here, you go up to say 2 or 3, you can see your cash required moving up and your profit potential moving up as well. We'll go ahead and do 4 of these, and we'll place that order. Okay, so that's how that works. Now I want to show you how a trading simulator, and I've set some of these trades up, and let me scrunch the screen down so you can see more on one page. So here is going back in time. This is starting from November 21st. And imagine you placed this condor. It's a week 3 January expiration, and we can use these buttons to go forward and backwards in time. You go all the way to the end if you wanted to, but for the sake of this demonstration, we'll just show you how this works. So you can see each day going by, and you can see the trade, the P&L starts off negative, which is normal because the theta decay hasn't worked. You can see the RTI is green, and that means good or do nothing. So Theta Trader tells us do nothing, just sit tight. You can see the trade, the P&L is starting to get better. And then it turns blue, and blue means take profits. So here's the real key, folks, is you can automate this. So when Theta Trader gives you a profit signal, and when it turns blue, your order is automatically placed for you. So that's the automation. And also when there's too much risk, I'll show you how that works, and that can be automated too. But so you can see that's kind of a typical condor. You sell the trade, it kind of chops around, moves around, in this case by not too much and not too quickly, and then theta decay works, and you're able to move on to the next trade. You see the expiration date was back here. So there's a condor for you, and here's a dragonfly. It's the same expiration, and again you see the green RTI, all is doing well, and then it turns blue here. And with 26 days till expiration, that's your profit taking signal. And let me double check something here. Yeah, turn blue the same day on the Condor as well. But let me show you, it's not always the same, and that's why we like the Dragonfly. Here's another Condor, and the yellow, I can point out the yellow color here changes, and you can see the trade is negative, but yellow just means a little extra risk at that point, but still do nothing. It's just the elevated level of risk. And you can see why. You got into it and it immediately starts running higher very quickly towards the upper boundary, towards the short call position there, the short call spread. Okay, but trade's still negative, but still do nothing with it. And that's what's nice about having ThetaTrader giving you these signals, because you might be getting pretty anxious up in this level here and you might want to get out of it, the trade, and ThetaTrader really gives you some discipline. Of course, only hindsight tells you if you would have or could have or should have done something. But so here you go. You get a profit taking signal here with 3 days remaining. It turns blue, and now it's time to get out of the trade. And these trades are never held till expiration, or basically almost never. It's rarely going to hold you till expiration if you're using the automation, and we don't ever recommend you do. So we'll be working with you if you have a trade that you've been sitting on and it's getting close till expiration. So you can see here, let's keep this in mind. That's the December Iron Condor. So with 3 days left, you took profits on that. So how about the December Dragonfly? You place it on the same day, and let's look at the difference in how the Dragonfly behaves. So you can see it's running up closer and closer to the short calls, but the trade is still profitable right here. And then look at this, it turns blue. You get a profit taking signal here with 11 days till expiration. So you compare that to the Condor. So if you had placed that same the same trade, or the same, let's say if you placed a Condor and you placed a Dragonfly, you would get out of the Condor. You'd have to wait for another, well, you'd have to wait about a week longer before you get out of the Condor compared to the Dragonfly. That's why sometimes the Dragonfly can be more robust, and we like it quite a bit more. So you can take money off the table here and go on to your next position. So let's look at a different trade. Here's a July week 2 expiration. Here's a Condor. So everything is working out okay, but the trade is getting red. But really, the thing to pay attention to is the RTI. And look at that. You get a red signal, and that means too much risk. Take your loss and move on to a different trade. And if it turns red, you can also automate that as well. And we'll show you how to automate that so the orders are placed for you. You don't have to screen much. I just wanted to point out that, you know, we're not going to just show you all winners. So yes, there will be losing trades if you're trading. You can't avoid that. But let me show you the difference though between the Condor, that's the week 2 July Condor, and here's the week 2 July Dragonfly. So it's turning yellow, elevated risk. Look at that. You have a profit taking signal with 15 days till expiration. So the Dragonfly ends up being a winning trade, but that's the Condor, the same expiration, you have to hold it and you end up getting an exit signal there for a loss. So we like the Dragonflies a lot. They can be a lot more robust in certain situations, as we've seen. Doesn't mean a Dragonfly won't ever take a loss, but they will take less losses than a Condor. So that's the distinction. And the trade-off there is you have a less profit potential, but they are more robust. And let me point out, before I jump over here, let me point out how to go look at, there's also something called the trade builder. We won't go into that really, but it's just if you want to build your own trades from scratch, you can. but I think I also pointed out you can modify any of the theta trades as well. But if you want to look at your closed positions here, you can do that on the dashboard, or from the dashboard, or from the menu up here. And I wanted to point out something here. You'll notice there's 20 trades on this page. These are all closed positions, so there's a total of 20. 16 winners and 4 losers. Okay, there were 13 sold or short option spreads, like where you're collecting premium. 13 winners and 0 losers. Now, there are 7 long or bought option spreads, 3 winners and 4 losers. So this is actually kind of representative of what you might expect. You're going to lose probably a lot more often when you buy premium and pay for it compared to when you sell premium. But don't make too much of the results, because this is just me placing trades via webinars every week randomly. And you can see, I think a part of this big gain here on the long options is probably from the gold position. Where is it? It's yeah, well, here's one of them right here. You can see a big winner on a gold position we had that we did in the demo. But anyway, just wanted to point that out, that over a long enough period of time, you should end up with a scenario where your short option spreads are performing better in terms of your win-loss ratio. That's for sure. Now, we mentioned gold briefly. We do have gold here as a symbol available to trade, but not in a neutral manner. It's only going to be bullish or bearish, and it's kind of work the same way. So here's an April gold spread that we're going to actually buy. So if you're bullish, we're going to buy this gold call spread. And I'm going to touch on this in just a few minutes as to why we put this in here, but we kind of like having exposure to gold, bullish exposure, I should say, just to specify. So we can we'll do three of these spreads. And you can see on the graph here, this is what it looks like. We're buying the 28.55 calls and selling the 29.05 calls. So that's what it looks like here. And we'll just go ahead and place that order. And there you see it right here. All right. Now, I want to point out one other item here before I show you some of the details, and we're going to jump into that trade alert. Remember, we focused on the Condor and the Dragonfly and the selling the call spread and selling the put spreads, which is fine because those are non-directional strategies. But if you wanted to be bearish on the stock market or maybe bullish on the stock market, there's all these strategies here that are pre-populated. Something we came up with called a bear hedge, and I'll show you here what that looks like. It's essentially selling an out-of-the-money call spread and using the money received to finance the purchase of an out-of-the-money put spread. And oftentimes you can do this for even money, so it doesn't cost you to do anything for the trade. I'll give you an example. So you would sell this out-of-the-money call spread and take the money you received for that and use it to buy an out-of-the-money put spread. So that's kind of how that works. I won't go all into the details here, but you could do this here. Sometimes it costs you a little bit of money. Sometimes you can do it for a credit or even money. But just want to point out the flexibility in using ThetaTrader and the ease of use. And then, of course, the RTI will also track positions as well. So let's take a look here at one other thing. We're going to look at that trade alert. So you'll see here, there are these two trade alerts. And this one is the Russell Dragonfly, the Russell 2000 Dragonfly. And this one here is the NASDAQ Half Dragonfly. And we'll go ahead and view this first one. So if you receive a trade alert from us, this is what it looks like from your dashboard. And then I'll show you what it looks like when you receive it on your phone. You'll receive a text message. So you'll receive the trade alert, you'll get a graph, and an explanation here. So selling the February end of month Russell 2000 Dragonfly spread. You see 44 days till expiration. So you're entering a new position. So here's where the market's trading. You're selling the calls here on a net basis, and the puts here collecting premium on a net basis from the puts you're selling and the calls you're, or I should say the puts that you're buying and selling and the calls that you're buying and selling. The net result is you're collecting premium. You can see the quantity is pre-selected for you. Let me squeeze that, magnify that. Want to make sure you can see everything. So you can change the quantity only down. You can't go up. So you can't add more risk, but you could decrease the risk if you wanted to. And it shows you here when you hover over, gives you a synopsis here on the order, the entry price, premium you're collecting, how much cash is required, 44 days till expiration, and you want to accept that trade alert. You just touch accept, and our technology processes everything else for you. So that's how easy it is to do a trade alert. And then here we'll look at the other trade alert for today. And sometimes people ask, how many alerts should you expect? Well, we're not day trading, and I'll get into that a little bit here later, but we're certainly not day trading. So if that helps, you're not going to receive alerts every day. So here's a little explanation on, this is half of a dragonfly, just using the calls of a dragonfly. Feb week 2 half dragonfly call spread, selling just the call side of a dragonfly. It's more market neutral to bearish given there's zero short put exposure. So the key components in the NASDAQ being Apple, Microsoft, NVIDIA are all teetering on major trend breakdowns, suggesting elevated risk to earnings reports in coming weeks. So here's that position, has 30 days till expiration, selling a quantity of 4, and this is all pre-populated for you and your account, by the way. Each alert you receive is custom to you and your account. The quantities and everything and the expiration, you won't receive the same trade, 2 days in a row, or receive a trade for 100 contracts or something if you don't have the money. Everything is custom and sized to your account. So you can see here your entry price, trying to collect $2,532, your cash required $29,000, 30 days till expiration, and we'll go ahead and accept that one too. Okay, so there you have a rundown on the ThetaTrader dashboard. And let me show you here. I want to point out that under the My Account, you can go look at our proprietary research, something we have called TradeScope. We do it every day. We look at the charts, and then we look at the market outlook going forward, some of the global macro perspectives, watching what the Fed tool is telling us about the direction of monetary policy. So people love looking at TradeScope. It's real quick and easy. And then also we have something called the daily comments, which you get a lot of good feedback on as well. You'll get the current quotes for the day, and then you'll get a rundown of what happened in Asia and in Europe, and then also with US economic data. And then over here, looking ahead about what to expect, depending on what's on the calendar. And then here is the economic calendar here. So that's a great tool. People like using that. That's all available to ThetaTrader users as well. And then there's a great help file here under My Account. And I'll show you just a second, but I want to also point out there are videos here. So if you need help with the ThetaTrader dashboard or placing an order, these are all videos here, how to do that, how to place each particular type of trade. But you saw how easy it is, really. There's really nothing to it. It's very intuitive. There's more educational videos here. So just want to point, all this tutorial help is all part of ThetaTrader. And there's a great help file here as well. You see here an explanation of the color coding on the risk thermal indicator, how that works. Won't spend time going into the details, but it's all right here under the My Account settings. All right, so you've seen, I think, a good review of ThetaTrader and the dashboard, but let me show you, I think, what people really, really like is how well the trade alerts work on their smartphone. So let me switch gears here, folks. Okay, let me go back to our presentation. Okay, so you saw how the trade alerts work on your dashboard, but as you know, most people um, probably have their phones with them more than they're just logged into an app. So these are one-touch responsive trade alerts directly from your smart device. You simply touch accept or reject. And these alerts are what we call live or integrated with your AltaVest trading account. If you just touch the green accept, the order is placed. So much better than having to have an alert service that you have to copy your orders from, and you can make mistakes. I've had people tell me they bought when they should have sold or whatever, and that can be a nightmare. So here's what it would look like. On your phone, you'll receive a text message from us, and you'll just simply touch the link, and it takes you to the alert page. Should look somewhat familiar. So here's an alert for a dragonfly. You can see the quantity here, selling 9, the net premium being collected. You can simply touch accept or reject on the alert. You can change the quantity and lower the quantity if you'd like. See the entry price there, that's the price you're trying to get the order filled at. How much money you're going to collect if you're filled, and the capital required to place the trade, to maintain the trade. And if you like it, you just go ahead and you would just touch accept, and then the order is placed and it shows up in your Theta Trader account. So that's how easy it is, folks, to use Theta Trader, and especially those trade alerts. So here's how you can get involved with Theta Trader and have a Theta Trader membership. And if you have comments and questions along the way, keep them coming. I probably will end up answering some of the questions along the way as we continue to chat here. But use your chat feature there, and let's show you how to get involved with Theta Trader. Includes everything we just saw, your Theta Trader membership. So the Theta trades, those pre-generated spreads, the risk thermal indicator, remember it turns blue or red, and you can automate. In fact, I want to do something here. I want to go backwards, if you don't mind, because I forgot to show you something. Kind of reminded myself there when I just mentioned that about the alerts. So under my account, you go to settings, and let me show you how to automate those alerts or the risk and the profit management. So here you go on the activate risk manager section here. So you would just go under my accounts, go to settings, and then this is where you choose to get your alerts and your comments and so forth. And you check this box that says activate the risk manager. And if you want to use the default setting for the red risk manager, you go ahead and just make sure it's clicked here as red. But you have the choice where you could modify orange risk level, and that's fine too. But just remember, this would cause you to get out of more trades, but at a lower loss per trade, a smaller loss per trade. Or you could do a custom risk level, and you could go down anywhere from 25 to 50 on those deltas there. And so if you go down to 25, that's fine. That's more risk averse on a per trade basis, but it does mean you're probably going, well, it will mean that you're going to take more losing trades, but each loss will be smaller compared to these other positions. So if you want to go ahead and play with that, you can, but I just use the default setting here, and we'll go back to there, and you want to save those settings, but keep this in mind here. And then you'll see right below that, you can see activate profit directive. You see that right here? So you just check that box and then you save your settings. So that's how simple it is. That's a key component to using ThetaTrader and having the trades managed for you according to the signals and the algorithms and so forth, is to make sure you go to your settings and activate that. All right, let me switch gears again. Okay, I think we're back on track. So remember, ThetaTrader provides you with all the theta trades, the risk thermal indicator, and the trade simulator. You saw how much fun that is to use and useful. You can spend time with that going back and forth and using that functionality there as part of the back testing machine. So a value for all that software, $3,588. And we saw the one-touch trade alerts integrated with your account. Each alert is tailored for you and your account size. You simply touch accept, and then the RTI can automatically manage those positions for you. Those alerts are valued at over $4,400, that alert service. So your ThetaTrader membership includes everything you've seen today. ThetaTrader, the alerts, valued at over $8,000. But really what makes us distinct, beyond all that, if that isn't enough, is us. We are licensed and experienced, and we'll coach you along the way. So you'll have screen sharing sessions with us. We can be your co-pilot. You develop a relationship with a licensed trader, discuss your account, your strategy, your history. I think that's really invaluable. Most services and so forth these days are sort of all, chat bots and never speaking to anyone, but we're normal, real people over here. Value at least $7,500. I know people are spending $25,000 and more on education, but ThetaTrader gives you what you need to know to do this type of trading. So just to summarize, ThetaTrader software, the alerts, and the private coaching, over $15,500 value. And I don't want you to forget, as corny as it sounds, the the proprietary research. People look at that every day. You want to look at, spend just a few minutes on that. We make it easily digestible. It's proprietary only for ThetaTrader clients. $2,900 value on that proprietary research. And I mentioned those online video tutorials as well. Remember, that's always available at your fingertips, beyond the real people to help you as well. So again, going through the laundry list of everything you get with your ThetaTrader membership, the software, the alerts, the private tutoring, coaching, licensed experienced professionals, and the research, $18,500 value. But of course, it is not something we offer during our webinars at our retail rate. Our live events, when we do in-person live events, this is the rate we would offer ThetaTrader memberships at. So people would go to the back of the room and we have a table and we'd sign you up that way. But we do it differently now. In fact, we're going to do even better than $997. Our lowest price ever, $497. That's a lifetime membership. Just a simple one-page order form. Enter in your info, credit card, and click, and you become a lifetime member. And there's the link. Take a picture of this or screenshot of this here. That's my direct phone number and email. And the offer does expire this weekend. So you'll want to make sure to get on board for that. And here's even better news. You can get a free membership. So if you open your trading account and fund your trading account within 30 days, if it's 100,000 or more, you'll get 100% rebate. And if it's 25,000 and up, you get a 50% rebate. So people like taking us up on that offer. They figure, well, I'm gonna do this anyway, so I might as well get my account open and started and funded sooner than later and get that rebate. So that's how you can take advantage of those rebates. And there's also 30-day guarantee on your membership fee. So if something happens and you have to cancel within the next 30 days, just tell us and we'll just refund your membership fee. So a few FAQs along the way. Tax efficiency. Are you aware that futures and options are tax efficient? These are what they call 1256 contracts. That's what the IRS classifies them as. So here's a short example. I won't spend too much time on it, but compared to trading individual stocks, if you're trading options with us, you're going to have definite tax savings. That's because 60% of your gains are taxed at the lower capital gains rate. Usually capital gains rate is lower than your individual tax rate. So tax efficiency can add up to a lot of benefit for you. Also, it's less hassle. You don't have to itemize. All you get is a 1099 with your P&L. There's a picture of the guy here. It says his accountant going through his trades. Anyway, that kind of made me chuckle because it is sort of true. So very simple, but do consult your tax advisor or attorney on all of tax-related matters. How about an IRA? Yes, contact us for details on that, but absolutely, we have those transferring to us all the time. Why the E-minis? Well, they're liquid, they're efficient, and they're cost-effective. They have the largest market share of densely packed strike prices, 100 annual expirations for granularity and coverage. So what that means, folks, is according to the CME Group, you get superior execution compared to SPX options, cost savings of $4 to $15 per contract. This is where all the liquidity is because you get those tight bid offer spreads. So liquidity, a wide array of maturities, and that's important. So here's an example of what I'm referring to. You know, here's the market moving, and here's some calls, and here are some puts, maybe for a Condor or for a Dragonfly. Well, Theta Trader is searching every day for a new trade, and if it doesn't have enough strikes to choose from and enough expirations, it can't find them. So it needs the liquidity. It needs more strike prices to get that granularity. So you can see here, and then as time goes by, Theta Trader might find another set of calls and puts to trade, and as more time goes by, another set, and so forth. So that's why it's important. And when you're trading with us using Theta Trader, I've never seen this anywhere else, you're placing a Dragonfly with 6 legs as one trade. So it's one order, places one trade at one price. You don't leg in with 2 separate orders or 3 or 4 separate orders. If you try to do a Dragonfly with securities, you have to break up that order into 2 different orders. That's the only way I've ever seen it done with securities. So it's very inefficient and it's a mess. So you can't do a Dragonfly with 6 legs anywhere else as one order. And if anyone's found it, let me know, and I'll change my tune. But so far, I've not seen it. So you have immediate access to sophisticated option strategies with Theta Trader as compared to stock option traders, the retail stock options traders. She says most retail stock investors only have access to basic call and put options. They don't have access to option spreads or other more sophisticated strategies. And she's right. You don't want to be a rookie and just only buy options because then time or theta is against you. And again, this is a comment from her saying the appeal to retail investors to buy options, they're much cheaper, but potential for profit is not that high. So that's kind of what I touched upon earlier. 2021, 11% of Robinhood's active users made an options trade, but of that, less than 1% made a multi-leg options trade. So we don't want to be like that. We want to be sophisticated and we want to trade like the professionals do, and there's a reason they trade that way. So it's fun to trade this way also because you only track 1 or 2 markets, efficient margin versus stocks, and there's a clear cost structure. There's no payment for order flow. Keep in mind, everything we're trading is on the E-minis, not everything we're trading, but everything I just talked about on the E-minis trades at the Globex exchange. That's an electronic order exchange. So all orders are treated equally. There's no payment for order flow. Nobody's selling your orders. Um, there's no commission-free trading, folks, I guess is the point, whether it's Robinhood or anyone else. They've done studies saying that the orders are executed at prices inferior. Even though you're commission-free, you get, poor execution, cost you more money. So nothing of value is truly ever free. Our commissions are 5.25 round turn, all in. That's all inclusive, and that's on the E-minis. So our rates are competitive. But here's an example. I've had people say, well, look, I see these people are charging 2.25. But then I have to point out, well, that's per side. And then they add more fees on top. So the total's higher than what we charge. So you can see here, I just copied this off a big brokerage firm. Then they have this little asterisk here, footnote number 8. It says, that's per side. It does not include customary NFA, exchange fees, and additional fees. So anyway, the point is our rates are competitive. Keep in mind, Theta Trader is used differently by everyone. And also, I should have pointed this out earlier, but all calculations in Theta Trader with your percentages and your dollar figures are net of trading cost. Everything is presented net of trading cost. And again, any kind of account, an IRA, joint individual, corporate trust, LLC, we do all of the above. And just to kind of close here, why would you even consider Theta Trader? Well, it's an alternative and it may improve diversification and lower portfolio risk. And when I say risk, well, there's always risk from a million things, but real quickly, how about inflation? US dollar losing 99% of its value. Look at that. That's kind of this is 1971. And here's what a $1 million dream house used to look like, and here's what it looks like now. So that's really what inflation is all about. And people are talking about, yeah, inflation's down. Well, no, not. It's not as high as it was. It's actually starting to turn higher, but we're still, losing 3% or probably more of our purchasing power every year. So that's the inflation shark. Ron Barron, he says inflation's more like 4 to 5% each year. I tend to agree with him. That's why I just wanted to briefly mention gold. Gold's definitely made a record high this year. ETF demand, the budget deficits, are out of control. Federal Reserve monetary policy is all part of that, inflating the money supply. Foreign central banks are buying gold. The BRICS are trying to start an alternative finance system, you should say. Gold's up 78 times since the gold standard in 1971. That's pretty crazy. It looks like in a chart of NVIDIA or something. And then here we get quoted oftentimes in various financial publications. Here's one from last month about gold prices, pulling back from their record highs. Foreign central bank gold demand remains the most important bullish driver for gold prices. That's Mike Armbruster, partner here at AltaVest. In late October, purchases of gold by central banks remain strong. Year-to-date buying, so forth. So we like to have some sort of exposure to gold. That's why we put it in the Theta Trader platform. Central banks have never bought so much gold. Here's Alan Greenspan. Remember, gold is a currency. No fiat currency, including the dollar, can match it. Kind of interesting for a guy like that to be touting gold. So Theta Trader is the alternative solution. You can really trade in any direction. It's very nimble. So just to review the benefits here, strategies for all conditions, a wide margin of error on a lot of these trades, convenience with the automation, diversify. You don't have to always be long or bullish the stock market. And there's one-touch responsive trade alerts as well. No day trading. We're not trying to do that. You don't always have to choose an up or down direction. This is why we don't day trade. Anyways, I thought that was a good analysis there. Wide margin of error. You can see, like in this example, over 1,000 points between the short calls and puts on this Dragonfly. How about a time saver? Here's people spending 10 to 12 hours a day consumed by the market. Not many of us have time for that. And again, mostly alternative approach to trading. So you can be in any position, trading in any direction, and it could move independently of what, let's say, the stock or financial markets are doing. So you don't want this. You probably don't want that. We think you should have a portion of your portfolio set aside for access or exposure to alternatives, such as what we offer. And the S&P 500, it's really not a diversified index. You probably know this, but the top 5 stocks make up 29% of the market cap in the S&P 500. So you're really trading just, the top 5 or 10 stocks. The largest 10 make up 40%. That's pretty crazy. And here's the dot-com bubble. I just wanted to point this out. I don't know if we're in a bubble right now. I guess we probably are, but we're not trying to project or predict when it's going to pop. But keep in mind, remember the Nasdaq, it dropped 80%. So if you bought at the wrong time, you don't want to just sit there and passively be long all the time. Is really the point. It took you, I think, 15 years to get back to even if you happen to be unlucky enough to buy at the wrong time, to buy the highs. And then there's plenty of times in history where there can be 10, 5, 10, 15 years, 20 years periods of time where if you buy at the wrong time, you don't go anywhere. So that can last decades. So just to wrap it up, ending up on the trade alerts here, just accept those trade alerts with that green button, and everything's integrated with your account, or you can respond to your emails this way or on the dashboard that you saw. And then here's what it looks like on the phone. You just touch that link and it takes you right to the alert, and then you touch accept. So we'd love to have you on board. Become an AltaVest Theta Trader member. You get everything you've seen with Theta Trader and the personal coaching as well. You'll just go to the link here. And once you become a member, you'll see these 5 steps just to get your login credentials and your account opening link sent to you and so forth. And then you can begin accepting trades and alerts and chatting with us. We love those algo-driven options trades, and they help to control our emotions. That's part of what gets in the way. I think we could all attest to that. Strategies are bullish, bearish, or non-directional. And then don't forget that simulator as well. That's available to you as well as a Theta Trader member. Go backwards in time and run through any scenario that you like, or really run any strategy that you like. So there is our offer. And I'll leave this up here. And I think I did answer some of the questions that I saw coming in. People ask about Canada. Unfortunately, we can't work with you if you're in Canada or the EU, but do send us an email anyway. Sometimes, depending on, if you have a legal residence or something in the US, that can work as well. And let's see here. The minimum account, we get that a lot too. Well, if you want the rebate, you need 25,000 or more, but you don't have quite 25,000. That's okay too, but talk to us. I mean, it's not something you can really do with just a few $1,000s though. Not to your advantage, because you saw that each Dragonfly requires about $5,000 in margin. And how about this? If there's any other questions, I think that's it on the questions right now. But I'll leave this up here. Take a screenshot of this. You've got the link you need to become a member, and you've got my direct phone number and email. So give us a ring, and I'm glad you could join us. I'd love to chat with you, and we have other people here to talk as well. If you have comments or questions, I'd love to get your feedback. And I think we'll wrap it up today. So thanks for joining us, and let's have a great weekend. Thanks, everyone. Bye-bye.